And we're live. Welcome, folks. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you back for one of our bi-weekly sessions with the great Stephanie Pomboy, who you can see is joining me here from a new location this week. Steph, how was the trip out west?
It's always great to get out here for the summer. It's definitely my happy place. Bear country, I feel right at home.
Well, good, because you might be hanging out with the only bears left, which
I
we'll
guess
talk about in a
so.
moment. Yeah.
It feels that way. Yeah.
All right. Well, look, an apology, folks, for us starting a few minutes late today. Just technical issues all the way around here, but we soldiered through it.
Yeah.
Thanks for your patience and your fortitude there, Steph. But we're going to make up for it by making this one of our best ones ever.
Okay, there you go. I'm ready.
Well, look, folks, lots to talk about with Steph. One thing I'm going to try to create here on the fly, and I'm probably going to butcher this, folks, but later on this afternoon, actually this evening, at 7 p.m. Eastern, 4 p.m. Pacific, I'm going to be having a free webinar that I'm going to be hosting for Ted Oakley. You folks are probably, most of you viewers are familiar with Ted Oakley. He's the founder of Oxbow Advisors. Ted, amongst servicing a lot of high net worth families and managing their money, he oftentimes publishes a lot of books about kind of key subjects around wealth building. And the one that he's just released recently is all about what he calls second generation wealth, but it's basically raising money smart kids. Whether your kids are minors or whether they're, you've got adult children, Ted is basically sharing all the best practices that he has witnessed over his 40 plus years in the business of seeing the families that have successfully, passed wealth on to the second generation, taught their kids about money and had their kids take the torch and then grow the family wealth. But he also has lots and lots of stories where that torch was passed and then the kids actually blew through the money and then didn't have anything to leave over to the third generation. So he's going to be sharing his observations of what those best practices are and then taking live Q&A. This is totally free. So if you haven't signed up for that yet, folks, go to thoughtfulmoney.com/kids right now. Sign up for that. Everybody who registers will be able to watch the webinar, ask questions. If you can't participate live, don't worry, because everyone who registers is going to get a replay of the entire event. And again, this is all totally free. Sorry for that commercial, Steph, but wanted to get that out there, given how timely it is. I know this is a topic that's near and dear to your heart too, financial literacy.
Yeah, absolutely. Yeah, I mean, you're doing a tremendous service, and having Ted do that talk is fantastic. So absolutely. Kudos to you. Last time we chatted, you were about to go sit down with your teenage niece, I think, and give her some advice. So this parlays right into that.
It really does. That talk went well. I gave folks sort of an update on it on one of the last weekly market recaps I did with Lance Roberts. So I won't go through it all here now, folks. But yeah, it went great. And I'll be peppering, I'm sure, today's conversation with Ted with some of the things that I found worked well in that discussion. But on to bigger things. So, Steph, I initially, I changed the title of this right as we were hopping online today. So I'm calling the title of today's session, Bombs, Bullion, and the Big Trouble with Student Loans. So we got lots to talk about all these. Why don't we start, if we can, just with the big news, right? Since we last talked over this past weekend, America took its first active offensive role in the Iran-Israel conflict. The administration is saying, hey, it was a one and done type of thing. We'll find out what the implications of this are. My question for you is that over the weekend, those of us who are following this closely, the discussion was all about how far down our market's going to open on Monday, how far up is oil going to open. And we basically got the exact opposite of what everybody was talking about here. And so my question for you is, what implications, if any, do you think may come out of this latest action? But B, what do you think is causing the market's optimism here? Is it, hey, this was successful and this may be opening the door to greater odds of peace in the Middle East and they're pricing in some big peace dividend? Or is this just Pollyanna-ish thinking where they're just trying to put a positive spin on anything and everything?
Well, I think when you look at the stock market reaction relative to the dollar and the Treasury bond market reaction, it seems like it was clearly more of a risk-on mood than it was a peace dividend kind of mood. If there was a safe haven bid to the U.S., it was pretty feeble, I guess is my point. When you look at the dollar and Treasury yields, it basically barely moved. So it seemed more like a risk on, and maybe that was a function of the fact that the oil market, as you said, rather than being $80, which is what I sort of expected we'd wake up to Monday morning, actually went down. So I think maybe that was it, because obviously if you don't see higher oil prices, that's tremendously supportive for risk assets in terms of lowering the presumably the second largest cost of business is outside of labor. So, that might be it. It could just be, trying to put a positive spin on things. But I do think that in the broad sweep of things, what we've seen is a move by the administration that continues to burnish this shift from the sort of, let's say, globalization move to more of this multipolar, this mercantilist agenda, and that being because essentially, in addition to kind of blowing up this situation between Israel and Iran and kind of forcing a peace accord, I think that action, that very aggressive, strong action that the president took over the weekend, sends a signal to Russia and China about any of their malign intents. That the U.S. isn't just going to stand idly by, and that we're going to take bold action when needed, even though our impulse is not to put boots on the ground anywhere around the world. That doesn't mean that the U.S. is just going to sit back and let China and Russia and other bad actors run roughshod. So that might be another aspect of this that's worth keeping in mind, especially as we move forward and in, I guess, 2 weeks, have the BRICS Plus meeting, where Russia and China obviously will be paramount in discussions about the further growth and expansion of their trade relationships and their move toward developing a joint currency or trading currency. So, I'm kind of stringing together a lot of thoughts there, but I do think there is some connection between our national security action and what it means for this whole de-dollarization, globalization theme that we've been talking about every other week now.
Mm-hmm, mm-hmm. All right, so sort of sends an under new management message, right?
Yes.
This isn't the U.S. that you've been used to dealing with, at least for the past 4 years.
Very well said. Yeah.
And okay, so I understand that part. How about is there optimism? And again, I'm just trying to get a sense for why the markets are just so unsinkable right now, despite all this stuff that would normally, we would think, put some sort of risk premium on the markets. One of the big sources of uncertainty this year has been trade and tariffs, and the administration, wanting to restrike all these trade deals with all the major trading partners out there. Does this strengthen America's hand with those negotiations, and is that potentially one of the reasons why things are so buoyant too, where they're like, okay, well, Trump's showing he means business. He's showing he can get the job done. To your point, he's showing he's not going to tolerate, things he doesn't like very often. So maybe that means these other trade deals are going to start getting struck more swiftly because the countries are like, hey, this guy means business.
Right. Well, I think that could definitely be part of it. Another big moving part that we haven't yet discussed, although we're only 30 seconds into this conversation, is the shifting expectations around the Federal Reserve. And I think that's really important. Now that there's more chatter about a July possible rate cut, whereas previously everyone was thinking maybe September, possibly for the earliest. And now we've got 2.5, let's say, Fed governors coming out and saying, we might actually have the rationale to move sooner, as soon as July. So I think that's obviously a huge support under the markets if it looks like the Fed is going to be a little bit more accommodative.
Yeah, I'm curious. Do you think that those dissenters, or I won't call them dissenters, but more dovish people are sort of leaking those or making those comments as a way to sort of signal to the administration, hey, I'm a little bit more friendly than the guy sitting in the chairman's seat?
They may be jockeying for position for the next Fed chairman. Is that what you're hinting at? Yeah, exactly. Like, here are my bona fides. I'm very much in the president's camp. Maybe, very well could be. But we'll see. You know, the Fed has notoriously tried to have consensus, and clearly there isn't a consensus as it stands right now. And Powell seems to be at very direct odds with Bowman and Waller and possibly Goolsbee. And those are three people who, you know, are fairly high profile. So it'll be interesting to see how that all plays out. Obviously, we'll get a lot of data between now and the meeting that will really decide the action. But I continue to believe that, you know, Powell, this is really not about the economic data for him. This is about showing that he has the stones to stand up to Trump and that he's not going to get pushed around. Because, you know, there's no question that the case for the Fed to be cutting rates today is better than it was in September. You know that I'm not an advocate for the Fed intervening in the markets and trying to set the interest rates that the market should be determining, but this is the world in which we live. And if they're going to do that, certainly the rationale for doing it now is much stronger than it was in September. And I think it's not for nothing that the bond market slapped the Fed across the face when they started cutting rates in September, because it was so nakedly political. And again, you know, there wasn't really the economic justification for it. So the bond market vigilantes said, look, we're gonna reverse any stimulus you're trying to inject into the system by exactly offsetting the drop in the Fed funds rate by driving the 10-year yield up in equal measure.
Right.
So we'll see if that happens this time around. I suspect that the bond market probably won't sell off the way it did then, again, because the backdrop is more dovish. But I wouldn't expect to see a dramatic rally either across the Treasury spectrum because of our fiscal situation. And that's another aspect of this, Middle East situation and our involvement there. Is it certainly puts paid to the idea that we're going to have any reduction in spending, as particularly as relates to one of the biggest components, which is defense spending.
Right.
Yeah.
Which already was getting increased too.
Yeah.
Yeah. So before this, the defense was getting its unfair share. All right. So number of different things. First and foremost, folks, just let us know where you're watching from or something in the live chat here. The live chat seems real quiet this morning. I just want to make sure it's working. Also, from some of the few comments in there, I just want to note the dog in the back of the room is not dead. She's just sleep. She's a champion sleeper. She's all fine.
She's already had a puppuccino and a 10-minute walk this morning. So she's wiped out. It's been a big day.
Okay. All right, good. I do see folks posting here, so thank you. In just a sec, Steph, I want to get to what's going on with student loans, because it's tied into really some of the weakness that we're seeing in the economy, but basically it ties into inflation. It is a component that ties into inflation, but probably an increasingly important one. And I know, a lot of your analysis right now is saying, hey, folks, inflation worries are likely to be very overblown at this point in time, and we should be worried more about the disinflationary forces that are slowing the economy. Real quick, just on Powell, I totally get what you're saying, and I just want to clarify to get your opinion, and I know you're just guessing. So if Powell is really trying to underscore the Fed's independence, hey, I'm not going to let the president push me around, is that, and forgive the pun here, it's not intentional, but is that trumping him doing the right thing? Like, you can make an argument he made a political decision, back in September. Can you make an argument now that he's making an egotistical one that is not in the interest of what the Fed should be doing?
Absolutely. I mean, again, I am not a proponent of the Fed intervening here, but if they're going to be active in the markets, it makes much more sense for them to be doing it now than it did in September. And so, if inflation is definitely decelerating and the run rate is even slower, and we're clearly seeing some weakness on the employment side, and those are their two mandates. Yeah, I think as ever, Trump will be right for calling Powell too late in his, definition of too late. I mean, clearly the slowdown is really in train. We just got the Duke University CFO survey out. And again, it was very downbeat assessment from CFOs about the uncertainty, and they're very concerned about tariffs and the impact it will have on their margins. And so they're really restraining CapEx and by extension, hiring. So, this is an environment where I guess, if you're a proponent of Fed, intervening, then would be the time for them to do it. But again, I do think, yes, Powell will probably dig in his heels, just from an egotistical or political standpoint, either way, at a time when the case for cutting is certainly stronger than it was when he was cutting.
Yeah. All right. And I'll try to
tell. You can tell I'm very much milquetoast about the Fed doing anything right now. I mean, I just feel like the Fed is the problem. It's not the solution. And their history has demonstrated that. So, I'm pretty soft on pushing the idea that they should be cutting rates. But again, my point is simply, if there was a case to cut rates in September, there's a much, much, much stronger case for them to be cutting rates today.
Right. No, I get it. And I share your general position, which is, hey, don't intervene. But if you're going to intervene, intervene intelligently, right?
Right.
Yeah. And so it's interesting because, and this is how we're going to get to student loans and the whole inflation topic. It's been interesting at the past several press conferences that Powell's done. I would say more than in past years, the press has been pressing him about, hey, I'm looking at the real world data and we're nervous. We're nervous about the economy. We're nervous about jobs. And Powell actually this last time did say, hey, look, if you just looked at the data, we should cut. But he said, it's our job to be forward looking. And he must have mentioned forward looking over a dozen times in this last press conference. And he basically says, we're looking forward. We know we have these tariffs coming. We think those tariffs could be inflationary. And therefore, we're just going to wait and see until we have more data, right? So it really, at least as the words he's using, are saying this is all based on our forward expectations for inflation. And what we're going to get into is, I think, Steph, your forward expectations for inflation seem to be substantially less than what the Fed's are.
Yeah. Well, I mean, I'm just comparing today to when Trump did tariffs under his first term. And the backdrop then, first off, the economy was stronger. The global economy was stronger. So the countries upon whom the tariffs were being imposed were in a better position to just let those tariffs ride and get, dealt with on the U.S. side of things. Today, that's not the case. I mean, I think one thing that's really clear is that prior, in the first administration, that all unfolded prior to the 9% spike in inflation. So household budgets had not yet been eviscerated by this massive ramp up in inflation related to the COVID stimulus extravaganza. And that really ravaged low and middle income household budgets. And we're still dealing with the consequences of that, as evidenced, and we talk about it every other week, by the soaring delinquencies on credit cards, auto loans, and now student loans. So the wherewithal for consumers to absorb these tariffs, if they were to be passed along, is so much lower today than it was during Trump's first term. And I understand that the tariffs back then weren't as broad. They're kind of unilateral now, whereas back then they were fairly targeted on specific countries and items. But I think that this idea that the tariffs will just be, it's a tax on consumers and they'll pay it, is just overly glib. Go back and look in 2018, when they put the tariffs on, the PPI went from 3% to 1.5% over the next 12 months. And the CPI went from, I think, 2.5 to 1.9. So inflation, both at the wholesale and consumer level, actually slowed after the tariffs. And that was because the rest of the world absorbed them on their end, especially China. And again, because the global economy is in a weaker place, I think if their inclination was to do that last time, it'll be higher now. But even if they do pass them on, I think there's a brick wall as relates to the consumer and his ability to absorb those. And the student loan thing is a major factor in that calculus, because as you know, we've talked about prior, and I guess yesterday TransUnion reported record delinquencies on student loans. I mean, they've been tracking this since 2012, so the history isn't, you know, centuries or anything, but it's long enough to give you the sense that, like credit cards and auto loans, we're probably seeing the worst credit situation for consumers since the global financial crisis.
Yeah. So okay. So much to dig into there. Let me ask one last thing on the tariffs, and then we'll go straight into student loans here. One of the things I have about Powell's stance is, okay, you're really holding off on everything because you're checking to see if these tariffs are going to be inflationary. Now, your argument, Stephanie, is, hey, look, let's look at the most recent data we have. The first Trump administration with the tariffs, they weren't inflationary then. Let's look at the state of the consumer household to absorb the cost of these tariffs, really bad. The data suggests so far that corporations, U.S. corporations, are actually eating the vast majority of the tariff impact so far. And as I've argued, they can, because they have record profit margins here, right? And they don't want to kill the golden goose of the consumer spending here. But the question I have is, like, look, tariffs should be, unless I'm totally misunderstanding them, it should be a one-time price shock, right? It should be a one-time re-rating. There shouldn't be inflationary pressure under them if we're not continuing.
One might even say transitory.
One might even say transitory. But my question is like, so the Fed doesn't really have any control over a one-time price shock, right? There's not really anything the Fed can do. There's nothing to fight if that impulse stops after that re-rating happens. So is Trump kind of worried about something that the Fed really even doesn't have any purchase in?
Yeah, well, I mean, this is where I come back to the idea that it's kind of silly to even be pushing on the Fed to cut rates, because, as you said, you know, they don't really have control over that. Also, what we learned in September is that they don't even have control over what interest rates end up doing. You know, they cut, but rates went up.
Rates went up, yeah.
So if we got a repeat of that, Trump would be very sorry. You know, you'd be careful what you wish for. So I don't think we would see that this time around, just because the inflation impulse is much lower today. And I think the bond vigilantes were really on edge about the fact that the Fed was cutting rates at a time when inflation was pretty much on the run rate. I think it was 2.5 on the CPI, we're 2.4 now. So it was basically the same, but the run rate was, you know, we were annualizing at a much higher rate. Today we're annualizing at a lower rate.
Right.
So I think that's what got the bond vigilantes all fired up last time around. So, but I do think, you know, it's an important point that the Fed really has zero control, and this idea that they somehow can wait and see what the tariff impact is and then fine tune their policy to directly address that is just laughable. But I mean, this is the history of the Federal Reserve. They are blinded by hubris. They imagine that they have the aptitude to navigate all of these little twists and turns in the economy and take policy exactly where it needs to be, when it needs to be. All evidence to the contrary. You know, I'm old enough to remember the Mr. Magoo cartoons where he'd wander into some construction site and it would be like one, you know, life-threatening thing after another. Unlike Mr. Magoo, who somehow managed to escape unscathed from all of these things, I feel like the Fed just manages to fall into every pit and get hit with every, you know, dumbbell and whatnot. So soon the piano will fall on their head.
Okay, right. Well, you know, and so I mean, Trump obviously calls Powell, too late, Powell. And of course, too late has always been a criticism slung at the Fed. I would expand it to what I think the criticism has been from many macro folks like you for a long time, Stephanie, is too late and wrong, right?
Yeah.
It seems like you feel like they're doing the same thing here. Okay, so yes, the Fed may be even, fighting a paper tiger, like, fighting an enemy that really is a phantom threat at this point in time. And you would think, as I would, well, at least if you're going to intervene, focus on the things that you actually have control over, right?
Mm-hmm.
Okay, so now student loans. So you kind of gave the punchline, Stephanie, that we're seeing record levels of delinquencies going on right now. We're going to talk about why student loans in particular are so important. Let me just read this that just came out today regarding the news you mentioned. Nearly 1 in 3 federal student loan borrowers are at risk of defaulting on payments as early as July, as delinquency and default rates soar in the wake of pandemic-era repayment relief ending. So it's not just delinquencies, we're seeing defaults go up too.
Mm-hmm.
About 5.8 million federal student loan borrowers were 90 days or more past due on their payments as of April 2025, according to a new analysis from TransUnion. That's roughly 31% of borrowers with a payment due. So we're getting close to 1 out of 3. That's up from 20% in February. So 50% increase in just a couple of months,
Mm-hmm.
and nearly triple the 11.7% delinquency rate as reported in February 2020, just before the pandemic began. The April figure represents the highest delinquency rate ever recorded. All right, so we're seeing a lot of weakness suddenly in the student loan market. Maybe not a huge shock to people like you and I, Steph, who have been tracking this, because we knew the consumer, was getting weaker, but for a long time they had forbearance on their student loans. A lot of people had, under the efforts of the Biden administration to cancel loans, kind of took on the mindset of like, I'm just never going to have to pay these things, and they expanded their personal budgets accordingly. So now all of a sudden the shock is on. I got to pay these things back. Oh my gosh, this is the debt I have to pay back because it's not dismissible in personal bankruptcy. And so the risk is you start having a cascading effect on all the other consumer debt, their credit cards, their auto loans, their rent, their mortgages, et cetera. So I guess first question for you, Steph, is how big of an issue do you think this is? And tying it to inflation, is this maybe the domino that starts really sending the cascade of a really slowing economy that makes inflation extremely hard to win out?
Yeah, absolutely. I mean, I think the issue of servicing the debt is certainly crucial, but think about the amount of marginal consumption that is siphoned away from spending, into service of debt. So what we lived in this sort of fantasy world for a long time because of the suspension of the student loan payments, where consumption was very strong relative to what it otherwise would have been had they been forced to be making those payments. And now we're going to discover just how much weaker spending would have been. And that's another thing as relates to the case for the Fed to be cutting rates today. I went back and looked. When they cut in September, the Atlanta Fed forecast for the near-term GDP had the consumer spending component at 3%, or 3.6 was the number, 3.6, which is incredibly strong. Today, their near-term PCE forecast for the near quarter is 1.8, so it's half the pace that it was back then, and we're still, I think if anything, that's overstated because we're just starting to see this hit in spending from the student loan thing, but also the give back from the tariff front running. Don't forget about that. We had this huge surge in retail spend going into the tariffs on the panicked expectation that, your car price was going to double and your washing machine price was going to double, so you better buy it now. And we've seen a pretty significant give back, at least as I look at the weekly retail sales reported by Redbook since then. So clearly, we're going to see a pullback in the consumer spending numbers, and that again should be a strong case for the Fed to be tilted more dovish because it really calls into question the capacity of consumers to pay higher prices. Generally, slowing spending is not an environment where inflation is moving higher. Quite the contrary.
Okay, so. Given your concerns here, Stephanie, I'm just curious. I'm going to ask you to prognosticate here a bit. But how how concerned are you about the future of the U.S. economy here? And I'll give one example. So Danielle DiMartino Booth, peer of ours, she has gone so far recently. She's been a real close tracker of the employment data, but also layoffs and things like that. And she's now really ringing a bell, saying, if you're looking for a job, you better get it real quick, because jobs are evaporating fast, and she's expecting we're going to go into a big jobs drought. This isn't even including the AI threat, but just a sense of like, we're going to go into a real unemployment crisis going forward here, or at least high unemployment. Do you share the similar concerns, more or less?
Well, no, I think clearly the data have turned. I mean, look at the trend in the unemployment claims, which is really a very strong indicator and ties directly into the layoff announcements that she's looking at so closely. So you've seen a huge increase, a material increase in both continuing and initial claims. I would also underscore that, again, in yesterday's consumer confidence report, the component that really stands out as the worst is the outlook for employment. The jobs outlook is hideous. It's now the worst it was since COVID. So that suggests that consumer spending will follow, because if you overlay, real consumption with the jobs outlook, whether it actually materializes, which it generally does, consumers have a very good sense as to what the labor market is doing on the ground, and they tailor their spending accordingly. You would be talking about a real slowdown in spending on top of what we're already looking at. So I think that's important. The other thing that really has me worried and is crucial as relates to this sort of silent support to the economy from the wealth effect, and just in general, the economy itself, is housing and what's going on there. And we're clearly seeing real softening in the housing market. And, even in areas that are little bubbles, like the two places that I spend my life, which I would say are really bubble economies, what's happening is that listings, I actually had dinner with a friend of mine who's a real estate broker out here last night, and he was saying the number of listings has increased 50% in the last month. And while prices, exactly, they went, huge increase. But prices haven't yet come down, because things are just sitting. And this is a market where there's no urgency. There are distressed sellers who need to sell necessarily. So they're just sitting there. And the same, as relates to where I am out on the East Coast in Southern Florida, where that market, we were also seeing an increase in listings and things just sitting longer on the market. But when you go into sort of the real world, outside of these little highly, inflated bubble universes in which I seem to function, the situation on the ground is really looking pretty bad. You're seeing a huge increase in cancellations, and I think it was 1 in 7 or something housing contracts were just walked away from in April. I'm waiting to see the May numbers, which come out any day now. And that obviously the home builder survey last month, went back down to its COVID lows. That you've seen a lot of weakness in the home sales data relative to what it should be doing this time of the year, which is seasonally when it really should be doing quite well. And this all comes back, of course, to what happens to interest rates. People are locked in because of the mortgage rate situation. And so, again, this becomes a question. If the Fed cuts, do mortgage rates go down? And if so, how much? And is it enough to really alleviate that? And if it is enough, does that actually lead to deflation in home prices? Because suddenly, people are able to move, so you get even more supply on the market. People have an ability to sell and relocate. So, all big questions, but there's a lot of uncertainty as relates to the biggest asset for most households out there, which certainly isn't going to be helping their confidence and, by extension, their spending, one presumes.
So you're absolutely right, Steph. Headline I saw right before we hopped on here, U.S. new home sales, their month over month change just came in at negative 13.7%. That was forecast at negative 6%. So basically more than double. Previously, it was plus 11%. We are continuing to see lots and lots of weakness there. Now, I've had a number of housing analysts on this channel recently who have been echoing all this. Stephanie, to your point about cancellations, I think the last time you brought that data point up, I asked you if that was just for new homes or existing. And I think you thought it was for both, but you weren't sure. I did confirm with Melody, right, that it is for both.
Okay.
So we're seeing cancellations in both of those markets there.
Yeah, makes sense.
I think it's very telling. I'm a little shocked, actually. So it's a very bifurcated housing market right now. You've got regions like the Northeast that have had less inventory than, of course, the Sunshine States where all the development happened. And so, right now we're seeing, weakness in some areas and relative strength in others. But Steph, you live in probably what should be the most strong place right now. Right?
Yeah.
An area that doesn't have a lot of room available for development. It's, ground central for everybody who's fleeing states like mine, states like New York. In fact, the New York election yesterday, I think, just gave a lot of new people reasons to consider moving to Florida. You've got, the White House South just a stone's throw away. So if there's a place that would be experiencing uncommonly high demand right now, it would be there. And you're saying that listings there are going up.
Yeah, listings are going up and things are just sitting longer. There's no urgency on the part of buyers to buy. I am just, just wiping my brow that I sold my house, before this happened. I mean, it was just luck in terms of the timing, but I would hate to be sitting there trying to sell right now because the market is definitely slowed down materially. So we'll see. But, I think this interest rate question is really going to be quite interesting to watch if and when the Fed does cut rates. And I think the odds are pretty strong that they cut. I mean, maybe not in July, but we'll see rate cuts this year. How does it affect the mortgage market? That's going to be really fascinating to watch, and the Treasury market in general, because of course the only reason Trump really cares about Powell cutting rates is that he imagines it's going to reduce the deficit by bringing in the interest expense. And I would say that's very much of an open question. So we'll see.
Well, and you could do that, but then the question is if the housing market is rolling over and the economy is rolling over, tax receipts might go down by more than the savings you get on the national interest and the debt, right? So first off, I do want to give myself a slight little pat in the back here. I've been saying for a number of years that supply is coming. I was stealing that line from Game of Thrones. And I think we can now say in probably a frighteningly large percentage of markets, supply is now here. Right. And that's the big issue. And most of the housing folks I've been talking to, Stephanie, share your view there, that it really isn't a story of mortgage rates. It is a story of prices. Like basically prices have to come down. And they also share your thought that, I mean, first off, how much is the Fed going to have to cut to really bring mortgage relief to folks? A lot. Right. And it's only going to cut that much if the economy is really starting to show signs of struggling. Right. And then also they share your thought that as rates start to go down, you're going to have some of these, locked in homeowners start to bolt. Right. And so, that's going to add additional supply and B, so basically it's not going to provide the relief that a lot of people think that, lower rates might, at least not for some probably pretty long transitionary period here. So we've got, I think, two really big things just to make sure we highlight for folks. We've got weakness in the housing market, which, as you said, Steph, is on average the largest asset that most Americans have, right? So there's a big negative wealth effect if that price starts going down. Then we have these student loans, which are compromising people's ability to pay their mortgages, to pay their rent, to pay their auto loans. So make the argument for me, if you can, why we shouldn't be worried about this.
Well, I can't make that argument. I mean, the one thing I was going to say is that in addition to everything you just mentioned, where there was this idea that we had a shortage of housing. But we also have this construction boom that's been going on. I mean, certainly in where I live, there are cranes everywhere, but all over. And if you look at, I was just trying to pull up the chart, I had it here, housing under construction, there's more housing under construction now than there was at the peak of the housing bubble in 2005 in terms of total number of units. So this idea that we had some shortage of housing, well, give it a minute, because when all that stuff under construction gets completed and moves onto the market, we're going to have a glut of housing, not a shortage. And then combine that with what you're saying and the possibility that lower rates allow more supply to come on. It just adds fuel to the fire. So, I mean, I think this is an important thing to watch. We'll see how it unfolds, but clearly, the idea that you could see on top of everything else, a deceleration in nationwide home prices would be really, really problematic for the economy, just because here we've got consumers who are already delinquent on their bills at the highest rate since the back end of the Great Recession. And then all of a sudden, their biggest asset is deflating. And presumably, and I think it's true, they haven't levered up, they haven't extracted that phantom equity to the degree that they did during the housing bubble. But we are seeing some increase in home equity cash outs, which I think, that just happened in the first quarter, I think is interesting in terms of its timing, that it coincides almost precisely with the resumption of the student loan payment. So
do you see that as a sign of a weakening household balance sheet? Like, I need to borrow from over here because I got to pay more over there.
That's my sense. But because you're not seeing it reflected in the spending data. So it would seem to me that they're just trying to figure out ways to service this debt at this point.
All right. I want to ask you about the latest spending data, if we have any updates there. Real quick, just on inventory, I want to note that, first off, record construction, right? So people might think, well, they'll just put those projects on hold, if there's no buyers. And it's like, no, a half-built house has zero value to a home builder. They got to finish it and get whatever they can for it. So all of that stuff is going to make its way through the pipeline, whether the market wants it or not. Secondly, there's a whole bunch of other potential sellers this time around that we haven't had in previous cycles. Whether it's the corporate, the institutional investor, whether it's the army of small short-term rental owners that all jumped in, during COVID because it was going to make them passive, millionaires, and now they're realizing this thing is making me a passive pauper because it's taking money out of my pocket every month. So you could have, and I think we're already starting to, but we'll have I think good odds we'll have a increased surge in distressed, desperate selling from a lot of those players too, because it's not the roof over their head.
Yeah, absolutely. And I think you're starting to see that. I thought I had read some articles about some of these big institutional players trying to liquidate some of those holdings. And that would obviously be a huge deal if it began to broaden out. And, clearly you're seeing issues related to CRE on the bank balance sheets continue. So, this situation is not getting better. Let's not fool ourselves. It's just slowly getting worse every day because there's no relief from the interest rate front, which is what everybody's been waiting for. But again, I feel like it's one of those things, be careful what you wish for, because the lower rates could actually create the deflation rather than the other way around. So again, it's going to be very interesting to watch.
Okay, so I want to get to one more sort of inflation deflation topic. It'll be the bridge into gold. But real quick, Steph, is there any recent data on like retail sales or consumer spending that is worth updating folks on?
Yeah, I mean, I alluded earlier to the Johnson Red Book weekly retail sales data, and you did see that ramp up in late March, early April, and then it completely, gave it all back. And in the latest week, these are updated every Tuesday, so we have a number just through yesterday afternoon. It dipped down again. So it's not like it's not back to 2020 levels, but it's just moving in a straight line lower. and I expect that trend will continue. I was just trying to pull up the monthly restaurant performance index, and that index remains below 100, which is the expansion contraction line. And that area, that segment, as you know, has been struggling given all the bankruptcies we've seen from the fast casual restaurant chains. And, you know, so I think that situation continues to devolve. Travel is another area where we're starting to see things really get kind of squirrely. Some of that is international, but there's also issues with domestic demand. So we'll see. You know, we're just starting to get through that tariff give back. We're just starting to get into that data. So, you know, we're just about to get May data, which will really be important as relates to that. But so far, the data suggests the consumer is definitely pulling back. And not surprisingly, you know, when you can't pay your credit card bills or your auto loans, you're probably not running out to, you know, buy that new Louis Vuitton handbag. So we'll see.
Right. And of course, you know, a recession just makes all this stuff worse. So a recession makes all this stuff worse. What also makes all this stuff worse is material correction in the stock market,
right?
Which we had, and everyone's already forgotten about it because we're pretty much back at new highs right now. And the market continues to think that, hey, you know, only better days are ahead, which stands in stark contrast to a lot of the data that we're talking about here, Steph. But, you know, I presume, and correct me if I'm wrong, you know, a lot of the retail spending is still being propped up or buoyed by those affluent households that definitely punch above their weight. We've seen some data points, luxury brands, et cetera, where, you know, there's you know, we're seeing some signs of weakness there. We're definitely seeing places like Walmart that are seeing greater share of purchases from affluent customers who normally don't shop there. Yeah. But how concerned are you about the future of the stock market this year and in general? And then if we do have, you know, a more sustained correction, the knock-on effects of the negative wealth effect amongst that affluent buyer?
Well, I guess, you know, this is probably the perfect indication that the market's about to absolutely tank, because I'm so chastened from forecasting that I'm kind of inclined to just say, you know, I just don't see the market moving substantially higher from here. I don't know that I would short it, just because it clearly seems to be inclined to look at everything through rose-colored glasses. And now, you know, it looks likely that the Fed is going to cut, whether it's July or September. That'll be a tailwind. And if oil prices stay where they are, that is helpful as relates to their ability to absorb the tariff impact to their margins. It provides some offset. We also have this sweeping deregulation, which I think is important, and we'll see if the big beautiful bill gets passed and in what form. But so I don't know that I would necessarily run in here and say I'm shorting the market. But I certainly, and I will continue to pound the table on this, would be long hard assets versus paper all day, every day, and twice on Sunday, as they say. I think whatever gains are logged by the stock market will be purely nominal. And in real terms, you'll see equities probably go nowhere for many, many years. So I expect sort of a normalization of returns where you see that relationship that you and I have talked about before, of the S&P to the CRB, for example. It's sort of my paper versus rock proxy. Really start to move in the favor of rock. For a decade. So I think that we're at the beginning, the early stages of that secular shift from paper assets to hard assets. And so, yes, stock market might continue to just kind of perform, okay. That's my ringing endorsement of the stock market. Maybe it'll be okay, but in real terms, you'll be behind where you would be if you were in hard assets.
Hard assets, okay. And regular viewers know your general portfolio position. You're putting your money where your mouth is. And so, if you think that the Fed is likely going to have to pivot here one way or the other, either intentionally or forced to by events. That obviously, generally, Fed cuts are bullish for precious metals, for gold. We've had a little bit of a cooling off in gold and silver here, really not too much, and they're up a little bit today. But do you see right now then as potentially this cooling off providing a good entry point for where you think prices are headed in the precious metals from here?
Yeah, I would describe it as a golden opportunity. If you don't have a position to get in there, I mean, it's really a gift. We've got a really interesting setup just over the next couple of weeks. You had, I think, options expiration this week that was behind the push lower in gold as they tried to get those options in the money before expiry. But as we go into July, on July 1st, gold becomes tier one, on par with cash and treasuries as high quality liquid asset for banks. So that's important. And then 6 days later, the BRICS Plus meeting takes place in Rio, where one presumes they will announce further progress toward their trade block and their moves toward creating a joint trading currency. So I think all of that will be hugely favorable and supportive for gold, to say nothing of the prospect, which is no longer remote, that the Fed actually cuts rates in July as well, or at least tilts dovish at the press conference, which I think is probably more likely that they don't cut their dissents, and then Powell at the press conference kind of paves the way for rate cuts in September. But all three of those things, I think, will be very supportive of gold. And so I do think it's a great opportunity to buy. And if I weren't already fully positioned, I would be putting money there as well.
Okay. All right. All right. So Stephanie's golden opportunity here in gold.
Yes.
I want to note a couple of things. One is, it is an interesting time right now, at least from my perspective, because I interview a lot of smart people like you, Stephanie. Well, nobody's smart like you, Stephanie. A lot of smart people, slightly, less smart than you. But right now there are some that read the tea leaves and are bearish like you. There are some that read the tea leaves and are bullish. And two recent ones are, just interviewed Katie Stockman of Fairlead Strategies. Her outlook, she's purely technical. So she doesn't really take macro. She literally says, I'm not going to get distracted by narrative. I'm literally just going to look at what the market is doing and trade that, right? And so she is bearish on the market, thinks it's overextended, thinks more likely the price action is going to be to the downside. It'll still be volatile this year, but price action to the downside. Except she's bullish on the precious metals for technical reasons. Darius Dale, who also is very formulaic, but does involve macro in his overall view, his model is very bullish right now. His model is made up of stocks, gold, and Bitcoin. So while it is bullish on stocks, it is also bullish on gold. And so what's interesting here is I find interesting that smart people disagree on the direction of the general markets, but I'm also noticing that smart people who disagree on the markets are all agreeing on the precious metals. And maybe that's something that should concern us, which is that,
right,
on the same side of the boat. But, precious metals investors may take heart from that a lot of smart people are still quite excited about where those prices could go from here.
Yeah, and also I think if you had 100 people in a room of these smart people and in their audience, and asked them to raise their hand if they had a 5% or more allocation to precious metals, not that many hands would go up. I think most people are probably just, if to the extent they're buying at all, it's a very, very small exposure for them. And if I'm correct that we're on the doorstep of this secular shift from paper to hard assets, those allocations should go up materially. And obviously, when you're talking about institutional managers, the numbers are non-existent. I mean, exactly. if you have 1%, you're probably about to get fired. Yes, exactly. That's a career decision right there.
Yeah. All right. Well, look, wherever things go from here, Steph, you'll be helping us track it bi-weekly here. And it's so fun, Steph, to see the just great amount of fans that you have here in the live chat. I know you can't really watch it while you're talking, but you got a lot of people here that really appreciate you and your work, and like me, appreciate that you come here on this channel. Is there anything macro-wise that's on your radar that I haven't asked you about yet that we should talk about before we wrap up?
Wow. Well, I guess, what I'm trying to noodle through for this coming week is I might title my missive, "Thank you for your attention to this matter."
Yeah.
I think that's going to be my new title.
It's certainly been trending.
It was toss up because my working title was Tina, There Is No Alternative, and it was going to be a treatise on, I repeat myself, but the idea that there is no alternative to the Fed monetizing the debt, because when you go through, and I'm going to do sort of a postmortem that looks at what the run rate of foreign Treasury purchases is currently, and then what's going on with bank holdings and purchases of Treasuries, and then hedge fund exposure to Treasuries, and what that could all add up to in terms of marginal demand relative to the supply that we have to issue. And the conclusion, spoiler alert, is that there's only one thing that can save us, and that's the Fed with more cowbell. So again, this is why I come back to gold. But so that's a little teaser too, as relates to your the thing that you do with sending out some of your
macro pass.
Yes, your macro pass. I was trying to remember what you call it. So yes, I might have to send you this one as relates to that, since I've teased it out here for your audience.
Oh, thank you. We'll have a lot of people eagerly waiting that. So folks who don't know what macro pass is, so Thoughtful Money has a Substack, and it's free to join. And this is how we let you know about all the news going on here, as well as every video that we publish, or every webinar like tonight's one with Ted Oakley. And the premium subscribers of that Substack get a whole bunch of other benefits, but one of which is called Macro Pass, which is all these people that I interview, like Stephanie, have premium research that they conduct for their clients. And every week I get a report from one of those experts, a premium report, share it with the premium Substack subscribers. And it's a nice way to just stay on top of like the deepest thinking of a lot of the great thinkers that come on this program. So anyways, thank you so much for that, Steph. And when that's available, I will happily share that to our MacroPass subscribers. All right. Well, look, folks, I want to thank you all for bearing with us for the late start today. We'll be better next time, and that is totally my fault.
I don't think it was. It was certainly at least half my fault. So
no. Folks, Steph's being gracious. This one's on me. All right, Steph. So for folks that would like to follow you in your work, check out your thinking, maybe even subscribe to your premium research directly, where should they go?
Well, they should go to macromavens.com, and you can read some sample reports and learn about how to subscribe. Or you can follow me on Twitter, although mostly I just like everything that Adam posts. So that's
that's because a lot of times I'm telling people about how great you are, Stephanie, which is, they don't even need to hear me say that. You've already got way too many.
This is a mutual admiration society right here. So.
It absolutely is. So folks, again, just a reminder, if you haven't signed up for it yet, there's the free webinar tonight, 7 p.m. Eastern, 4 p.m. Pacific, with Ted Oakley about how to raise money smart children. The URL for that, again, is thoughtfulmoney.com/kids. I'm looking at that. Looks like I'm going to run out of space for that. We've got almost 900 people signed up right now. The thing maxes out at 1,000. So anyways, if you haven't signed up yet, folks, make sure you sign up for that quickly. And again, if you can't watch live tonight, don't worry. Everybody who registers will get sent a replay video. And again, this is totally free. It doesn't cost you anything. All right, Steph. Oh, and then last part, folks, I won't give you the full song and dance as normal, but if you want some help with figuring out how to manage your portfolio for a lot of the potential trends and developments that Stephanie thinks might happen, I think you should get that from a good financial advisor who takes into account all these macro issues. And when you layer that requirement on there, the universe gets pretty thin. But if you want to talk to one of the financial advisors who appear on this channel with me week after week who do meet those requirements. You can schedule a free consultation just by filling out the short form there at thoughtfulmoney.com. All right, Steph, well, look, what are you going to be doing for the next 2 weeks besides all the work now that you're out there in the beautiful West?
I'm going to be fraternizing with my fellow bears, and I mean the fur kind.
Okay, yeah.
Hopefully not too close, but from a distance.
Just don't get eaten. Yeah, and remember the old story. Hike with a buddy.
Yes.
And if you come across a friend, just make sure you can run faster than the buddy. You don't have to outrun the bear. You just need to outrun your buddy.
I have some slow hiking partners, so it works out very well.
Very, very, very wise. All right. Well, look, Steph, I really look forward to next week. Thanks so much for yet another great bi-weekly discussion. Everybody who hung out with us today, thank you so much for watching.
Thanks, guys.